I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge. All right, guys, Jeremiah here, Finding Your Edge, baby. Find your edge. Yes. Friday night, alone in Vegas, doing the episode solo. Sorry, Marty. I will catch up with you next week. He got some teeth pulled out, so he is unable to make it here. But week 36, 2022, football season starting up. Let's go Patriots. Come on, guys. Rebuilding year. Another one. Not a lot of talent, but it's all in the system, baby. That is the Belichick way. Yep. Do your job. Do your job. Follow the system, and the rest will take care of itself. Well, we'll see. We'll see without Tom Brady. We will see. On the real estate horizon, finished up the self-storage show in MGM, Las Vegas. It was really strong. It's normal show. You walk around, see a bunch of vendors there that are showing off their cool storage gadgets. But a lot of good feedback in the marketplace, and the market is softening a bit. You know, I don't know if it's from the consumer side where people are getting more strapped and they have less dispendable income and they're consuming less, or it's just overall there's more competition. Too much storage was built in some markets and more higher occupancy, higher vacancy, so more vacant units, and there is rent decreases. And that's really the biggest one is the street rents. What the rents are out there have been lowering. It's a big deal because over the last 2 years, rents have just gone up steady, month over month. I mean, huge 10 to 40% rent increases, which if you're in real estate, you know, year over year, that is insane. You do never get that much rent increase. I mean, when you pro forma and look at your models, you're lucky to get 3-4% in rent increases, especially when you're looking at apartments or industrial or any of these other asset classes. But yeah, 10 to 40%. But that gravy train might be over. But what does that mean? It just means you got to be smart. Cannot overpay and then think you're just going to get your ass bailed out because you have a lot more rent growth. That is just not possible. That's dangerous. As nimble, mid-sized, small investors and value-add investors, we got to create value quickly, and you got to protect the downside. And vacancy and rental decreases are your biggest enemy. Those can really hurt you. Where number one, you can't pay your investors and you have no return on your equity, your own investment. And number two, you jeopardizes you paying off your debt. So if you can't service those loans, or if you get into that 1.25, less than that 1.25 debt coverage ratio or less, that's a dangerous spot because that typically triggers the lender to say, hey, this is a risky loan. This asset's not performing and we can call the loan due. And that is a bad spot for us real estate sponsors. But that's okay. I mean, we're being smart and just got to be disciplined. Like, it's okay. You don't have to do tons of deals every month or every quarter or every year. But to that effect, I was just thinking about that in terms of deal volume. I think the average person that is not experienced in real estate, but they're in their 30s and they have a profession and they've learned their craft and they're earning money, or they have a business and they're starting to generate income from that business. I might be biased, I'm sure I am, but I believe real estate is the best place to invest your money. There is so many benefits to it that we talk about over and over again. And if you're listening to this, I'm preaching to the choir. So the four horsemen of real estate are, number one, you get your, year over year, month over month, or quarter over quarter cash flow. I mean, we all love cash flow, live and die by it. That is what business real estate is all about. Number two, you get your appreciation over time. Inflation works in your favor. Keep raising those rents over decades and decades. It continues to go up. Number three, you get depreciation, which are your tax benefits, where you're not paying tax on the first few years or more of owning the asset because you can offset it with those tax benefits allowed for commercial real estate. And then lastly, you get principal reduction. You're paying down your debt. You got fixed debt that you control a big asset. And then that asset grows while your debt stays fixed. And over time, you're paying it down with rental dollars. So you got 4 components to generating wealth. And then most importantly, it's a tangible asset where if you have a viable product in the marketplace, like it's an office space or it's an industrial warehouse, or if it's a self-storage facility and people use it, if it's an apartment complex or a mobile home park and people live there, these are tangible assets that occupy space in typically growing markets where people keep having more people. They have babies and they have to live somewhere and they have to shop somewhere and they have to do business somewhere. And, industries will shift and change, but real estate is fixed. I mean, it's a commodity in some way, shape, or form. Now, I know trends will change. People will live in cities or they won't live in cities, or they'll have cars or they won't have cars, or they'll work from home or they'll not work from home, right? Or things will get shipped to us in the air or through however they do it, robots. But at the end of the day, there is a need for the space because people need space. So real estate is a tangible, solid, real object that has value. And the real value is not in owning one piece of property, really, or a few pieces. It's in the habit and the consistency and the discipline of exercising this skill of investing year over year over year. You can't get years back, right? Right. The best time to plant a tree is 20 years ago, right? And then if you didn't plant it 20 years ago, the best time is to plant it right now. The famous Chinese proverb, right? So, you have to start and you have to find a way to plant your flag and make a position, put a position in real estate, and then, next year do it again and then do it again. And you just over year after year, I meet so many people where, it's just, I started in real estate with another guy, and my focus was just to continue to buy real estate every single year. And this is what my pure focus was, not earning income. It was about acquiring assets and adding value to those assets and learning a system and skill to find out where these are and then build assets and then just keep buying year over year. And his skill is building a business and focusing on other avenues. But over time, the difference becomes apparent where, the money gets burned away. Either you earned it or you earned it in a business or you earned it in a career, and somehow it gets spent, or there's an amount in the stock market, which is okay. And, there's some savings, but for the most part, there's really no sizable capital allocate. Like there's no capital that was really accumulated, nothing sizable. Right. But then the real estate over 20 years, in some way, shape or form, I figured out how to keep buying something every year, no matter what. And that grew, and I sold and I bought and I sold. But over time, that just continued to grow, and the equity grew exponentially. It compounded. So it was a significant difference over, 2 decades. And it's quite apparent when you compare it and see it when we started from the same place. So this episode is a bit of a rant and I'm preaching, but, I hope if you're out there and you're thinking of investing in real estate, you find a way to do it. I mean, just do something so you learn it and you put a position out there, and it's not always, you gotta understand what you're doing. You don't just go buy something anytime, anywhere, but learn it, learn some avenue, some niche, right? Find your edge, find what you believe is an edge in the marketplace. If it's short-term rentals, out in tertiary markets or in resort markets where you buy a house somewhere or an RV next to a lake and you put it on Airbnb and you're able to get $300 a night and you can lease out half the year in rents and you build up good reviews and you have good marketing. I mean, that's something. You own an asset somewhere and it will grow over time. Or if it's just buying a 3-bedroom, 2-bath house in some decent city somewhere where you just have enough rent to cover the mortgage, and over time you just keep paying down the mortgage and it keeps going up in value. But there's going to be problems, right? We all know it. Everyone on here, I'm sure, has bought some type of piece of real estate where the tenant beats the shit out of your house and you have to recarpet and paint and fix it all, and you got to release it and you have to pay the mortgage for a few months and no one was there. So those things are hard, and that's why I over time decided no more single family houses, but that's how I started. And then the natural progression is to move into commercial real estate where you get multiple tenants and you have more creativity and there's more opportunity, I believe, to find distressed situations where certain businesses didn't work out in that location, or there was an operator or owner or family that just mismanaged it and they're not maximizing the potential. They're not maximizing rents. They don't want to put a dollar back into the property. I mean, it's a real business. That piece of real estate is a business. And if they neglect it, the performance is going to suffer and the value will suffer. But it's a bit of a jump to just jump in and buy commercial real estate when you don't know quite what you're doing. But I think the first step is if you have a business and you already are renting a piece of real estate. I know this doesn't work in some markets like Los Angeles or New York City or some of the most expensive markets in the country. It might not be feasible for you to buy the location that you're occupying. But in other parts of the country, for the most part, look at buying your location where you don't have to rent anymore. And SBA loans are solid, where you can finance up to 90% of the transaction. Even sometimes when working capital or inventory, they'll finance. Other times they'll do 85%, but still 10 to 15% down. You lock in a pretty low interest rate in the whole grand scheme of things. And then you're able to build equity over time in your own property rather than paying someone else a monthly rent to occupy or to operate your business. And then if that's not the case and you're just a high-paid employee or you're building up a company that doesn't really use real estate, there's always investing. And I really want to dig into this more. I'm going to research this with my guys. But looking at crowdfunding platforms, what's out there, what's available online, and you can either be an accredited investor and non-accredited investor. Accredited investors have a lot more opportunities. You have to make $200,000 a year consistently for the last 2 years, or have $1 million net worth if you exclude the value of your equity in your house. So if you do that, then you qualify, and then you can invest in these opportunities that are online or through sponsors, like myself, where you go on their websites, you look at what they offer. Either they have a partnership offering where you can buy equity in their partnership, or you can go on these platforms and you can invest through these platforms or these online portals, and then you invest in equity. And typically you would buy units of a fund or of a partnership, or they're also called real estate syndications. It's all the same thing. Either a project or a series of projects or properties. And in the offering, in the private placement memorandum, it will outline these are the potential returns, and this is the structure of the partnership, where every dollar you invest in it would give you this much ownership. You will have this much preferred return on your dollars, and then you will be repaid back in this order of importance, where after you collect the rent and after you pay your debt, after you pay your expenses, then you will then pay out the partners in this way. And typically it'll share what the fees are that the sponsors or the general partners, the guys putting together the deals and offering these investments, what they charge, and then you will get a return over time. And you can check out platforms like CrowdStreet.com, RealtyMogul.com, Real Street, I think, is one. So there's a bunch of these platforms. I haven't been on one yet. I've flirted with the idea, but they charge a fee to the sponsor. So at this stage, I haven't made the jump to it. But it's there's opportunities on there. But at the end of the day, you are a passive investor, right? So if it's you or me and we invest in as a limited partner, you are counting on the sponsor or the general partner, the person, the real estate entrepreneur, if you want to call them that. They are in control. They are running the business. They are acquiring the property or asset. They are getting the debt. Sometimes they guarantee it, sometimes they don't. And they are the ones typically managing it or hiring someone to manage it and responsible to give you the reporting, to give you the accounting statements and your yearly tax return statement. And then hopefully you get your distributions that some people pay monthly and some people pay quarterly. But that's how you get a return. And then when they sell the assets or when they refinance, typically they pay back your capital and then split the profits based on whatever the structure of the initial offering was. This industry has exploded. There was a shift in the law when Obama was president where it allowed sponsors, like typical people outside of business owners or real estate investors outside of public markets who weren't a public company, to register as an exempt security where it's not a public offering, it's a private offering. And then these investors or entrepreneurs were able to then advertise all over the country. And as long as you get the accreditation from your investor, making sure that they are accredited, validating that they do fit the criteria, then you are in compliance. And that really exploded the private equity marketplace. And private equity means just these investors or these general partners or sponsors are going out and they were able to raise capital from people, professionals, anyone that was accredited, from high wealth individuals, family offices, and just a lot of different wealthy people. And I think this catapulted the real estate industry, where there was a huge increase in values, because I think there was an influx of capital that really wasn't available before this shift occurred, at least not at this scale. And this pretty much happened around the time, near kind of not my tail end, but midway through my investing career in manufactured housing. And you could see alternative investments, assets like mobile home parks and self-storage facilities and car washes and cell phone towers and parking lots. These alternative assets exploded with value, where all this new capital, where these innovative, creative guys, entrepreneurial investors, real estate guys came in and they would syndicate or bring together pools of funds from private investors and go out and buy all these assets and got them at typically a good price. And then the asset values were increased because of all this new demand in the marketplace. And they provided their investors a lot of good returns. And there was a lot of money made because there was a whole new market out there of buyers that were willing to go out and find these owners that weren't maximizing the returns, or they were just, these assets were smaller than what the typical institutions, the big public companies, weren't willing to go after or put the manpower after. And it totally changed the game. And now with access to information, and you can pull a database on any type of asset or property you want, people are going to go after every type of piece of real estate. And the value of the assets continue to rise. And there's more and more investors that believe in real estate sponsors or real estate entrepreneurs, and they're going to put their money behind them. And these guys are going to keep going. Like me, we're going to keep going out there and keep finding and building opportunities. And my thoughts around this, and this is totally biased, but this is my opinion, and that's why I can do this. I get to do a little podcast here and have an opinion, is why put my money in the roulette game, the casino wheel of the stock market, where every day this ball is rolling and then it just lands on some return, and it could go down, it could go up, it could go all over the place. And I have no control over it. It's really the basis of the return is not valued on the performance of the business. It's valued on sensationalist news, where the flavor of the market dictates how much the price of the stock is, or whatever the index fund is, whatever mutual fund out there is. And there's the sharpest, smartest guys in the world that went to the best schools, the best Ivy League schools, that have the highest math IQs there is, that know how to calculate every single trade and do whatever they can to squeeze out a penny out of every single edge they have in the marketplace, extracting value from it. And all the pension funds and wealth advisors and massive investment banks, they all collect everybody's money, and they get their fees up front, and they get their annual management fees, and they don't care what happens. They're going to put the person's money into whatever gives them the best brokerage fee or commission. And over time, the returns get diluted away because one, somebody gets their cut no matter what, and they're not really creating any value for you. They're just managing your money on a computer screen and putting it into some other index or some type of just public security that they just process and order online. Two, there's no tax benefits. You're going to get taxed every single year on your dividends. So anything you make out of the stock, it gets cut and you can't compound it. And then three, there's really not a hedge against inflation. Inflation's going to, it just ate up the market last year, whatever it really was, 7%. So by the time you get your fees taken out, you get taxes taken out, and then you have inflation hit you, what the hell is left? And unless you're stacked with capital and you can just let it sit there and get a real return of 3, 4, 5% after all those cuts, what is that really going to do for you or for the average guy? Absolutely nothing. But then you look at the average guy who buys a house a year or makes a real estate investment every year or two, like my grandparents when they're starting to pass away and at the end of their life, what had value? I mean, it was the real estate. That's where all the value was. After they struggled to pay it off or they managed it and paid the rent, at the end of the day, that continued to grow every single year. Now it takes more work, and it's not just set it and forget it, but over generations, over decades, there's tremendous wealth accumulation around that. And there was some tax benefits around it, and there was solid rental income coming from rentals. So I don't get it. I just think people are brainwashed. They're afraid to do what's different than what everyone else does. And there's this hypnosis in the marketplace. Like, if you have a certain amount of money or you have a 401k or you work at a certain company, you have to invest a certain way. And that's just the way things are done. And that's the way that it's safe and you're going to be fine. And it's all going to work out in the end. But it's a huge casino game, and that stock market and those institutions are making extremely risky bets, and who knows what could happen that could cause a chain reaction that could, if one of these institutions go down or a black swan event occurs, that is a problem. You will not make a return for quite some time, and the market will crash. And markets can crash in real estate too. But if you're disciplined and you know what you're doing, or you invest with somebody that knows what they're doing, then you weather the storm, you make it out of it, and then you come back over the years and you get better. But overall, my whole thoughts on it are this. It's like, just like Buffett says, you're investing in a business. So a stock is an ownership piece of a business. And when you're investing in real estate, you're investing in a business, period, right? Investing is about understanding business, not passively sitting back and giving your money to some wealth manager, letting accountants and attorneys tell you what to do. You run the show. You're the quarterback. You're the coach. You're the owner. Everyone is a business. You take responsibility for your own life. Nobody's going to fucking do it for you. There's no one else's fault. If you lose it or someone tells you something to do, you chose it and you lost it. Because ultimately, no one cares about your money as much as you do, period. It's still a cutthroat world out there, and people are very sharp. So if you don't understand, or I don't understand what I'm investing in, that's a bad investment. For me, I have to understand the underlying business of what the hell in the marketplace values whatever this thing is, this business or this organization does, and it doesn't make sense. And if it doesn't, then there's no reason I should be investing in it or anyone else. But I have a very simplistic view about this whole thing, and I'm sure there's a lot of really smart, complex ways to make money, but they're not for me. And it's worth understanding and researching, what it is you're investing in, how the tax implications actually work, and not letting someone else just blindly guide you into let the wolf go in the sheep's den, or the chicken coop, there's I think it's a scary place when you get somebody that really knows what they're doing and they're interests aren't aligned with yours, where they are able to prey on the weak. And if they make money on the naivete of other people, their ignorance, I think it's too seductive for them not to. And I believe that's what a lot of this wealth advisory is. Now, I'm sure there's a lot of great wealth advisors, and there's amazing firms that make people a lot of money, and that's a whole nother story. But for the average guy, there's not a lot of options. You're the last one on the value chain where you are buying you're paying for a ticket that's been marked up so many times that you're the last guy in line. You're paying the highest retail price for whatever you're investing in. But at the end of the day, I think the best investment anyone can make is the investment in themselves, 100%. And invest in your skills, invest in your knowledge, have emotional intelligence, invest in really cultivating a way to process your emotions, because like Buffett says, if you can't control your emotions, you can't control your money. And if you're all over the place and you haven't invested the time and energy into improving and growing and learning and not and understanding how you operate and how in your relationship with money and investing and everything and people, then you are going to make some bad decisions. And I've made a lot of bad decisions, and I learned from them, and I pumped a lot of money back into myself. And I think that when I say that, invest in yourself, I mean invest. If you can, I think the next best investment is a business. Start a business. That is, this country's built on entrepreneurs. And if you have the stomach for it, then building a business is critical, to building wealth. And then, like good old Kiyosaki says, the rich formula is build a business and then take the profits of the business and invest in real estate. I think that is the formula for wealth. And the more wealthy people I know, and they're not all, some of them aren't that impressive. I mean, they just were really good at one thing, and they built a really good business and helped a lot of people solve a lot of problems. They provided good quality service, and they met a need in the marketplace. And then it wasn't good or bad. I mean, it's just all subjective. It's all perspective, right? You could have a casino and people can gamble their life away, or you can sell health products and people are healthy. You could sell booze and people are, having fun, but they're poisoning their body. But it doesn't matter. My judgment or anyone else's judgment doesn't matter in the marketplace. It's what do people value and what do they pay for? And if you could build a system that gives people things that they enjoy or they value it and they're willing to exchange money for it, then you deserve the money. But once you have that money, who knows what's going to happen. The market and that service isn't always valued as highly as it was the year before. I mean, some years are good, some years are bad, but you better take that money and put it in real estate, because at least that sets a position, and that position will continue to grow over generations. Maybe not year over year. It's not liquid. You can't just buy and sell right away and get right in and out of it typically, but it will grow and it will accumulate and build generational wealth. That is my rant on real estate. So this is one of the early episodes here. Finding Your Edge. Check out the book, Finding Your Edge, How to Win at the Game of Commercial Real Estate. What I learned over the 20 years I've been in this game, and just learned some lessons here, 6 principles that were things that I picked up over taking a beating at times and getting some good wins. And also check out the website, patriotholdings.com, patriotholdings.com. I am originally from New England, so I called my company the Patriot. I love the Patriot, so I called my company Patriot Holdings, because you either love me or hate me for that, because everyone has an opinion about the Patriots. But the standard is high. The Belichick way really told me that, that there's no excuses. You do your job. You know your role. You know your skills, and you work your ass off, and you contribute, and you add value, and you stand behind what you say you can do, and you follow through. and you never settle on a win, or you never get too low on a loss. I mean, it's you take it one game at a time, one day at a time. You compete, all the good stuff. I mean, that's great lessons for business and life, because business is a team sport. So hopefully they can squeeze out a win against Miami this week in Miami. They never play good down there. It's going to be hot. So they are, let's see if Mac Jones can pull it together. New offensive coordinator. We have no more Josh McDaniels. He's over at the Raiders here in Vegas. I can't be a Raiders fan. It just doesn't work. But yeah, we will see how they do, and if the system endures, or if we're going to have to continue to build. But enjoy your week. Have a productive weekend. I am going to keep giving you everything I got on here. I keep it raw. I want to have fun. I'll always be real. I share everything I got. So just lesson of the day, go invest in real estate. Go do something in real estate this year. It's almost, you got 1 quarter left. You got 4 months left. So don't blow it. All right. I'll talk to you next week. For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.